Welcome to Market Radar. We're not investment advisors, security analysts, or brokers. The following information is strictly for entertainment and educational purposes only. None of the information here is intended as a buy or sell recommendation.
Welcome to another Market Radar podcast. It's July 17th, 2022. The year-to-date performances are S&P down 18.91%, NASDAQ down 26.64%, Russell down 22.19%, and the Dow Jones down 13.94%. All indexes continue their bearish trend. Our regime model is now saying an 80% chance of risk off. Deflationary odds slightly rose, but so have stagflationary odds. We are still in the longest stagflationary period that we have seen at a 42.9%, which is very high confidence. So we're likely going to be here for a while still not looking like it's ending. Let's take a look at let's take a look at the economic calendar first. We've got the Housing Market Index and Treasury International Capital on Monday. Tuesday, we've got housing starts and permits. Wednesday, we've got existing home sales, EIA Petroleum Status Report. Thursday, we've got jobless claims, Philadelphia Fed Manufacturing Index, EIA Natural Gas Report, and the Fed balance sheet. Friday, we've got PMI Composite Flash. Let's take a look at what ES did this past week. Had a rough start in the week, coming down, but then a strong finish on Friday. Pretty choppy ever since we hit the lows in June. And we're expecting more chop. We're expecting chop and slight uptick. We could see a bear market rally up to Momo. But as of now, it's not looking very strong. It's looking like we're just going to get some chop. ZN.
Yeah. Oh,
Is there anything you want to add to that?
yeah. So, just remember, guys, I know you guys are probably watching intraday, glued to your computer screens, and you're seeing something like Friday, Thursday we had this move lower, reverse Friday, this move higher, superseding the move from Thursday, saying, look, a bottom is forming. But between June's lows and the July lows so far, which were made on Thursday, you might say markets put in a bottom. Well, at least that's what people will tell you on the internet. And risk is, the market's priced everything in, and everything will go higher now. That is not a mindset to take. That is a very, I should say, arrogant approach or ignorant approach, because you're not accounting for what is going to have to happen here in the next 6 months. Now, the market is, yes, but to say that because we have a low in June and what seems to be a higher low in July, that risk is now back on, is a very, again, ignorant approach, because this means nothing in the grand scheme of the regime. Remember, the regime encompasses everything. It prices everything in, right? So you can't just look at ES and B and have the confidence and say, oh, this next 6 months is going to be okay.
Yeah, exactly.
That's what I've been seeing on the internet. So I just want to clarify that those that are looking at the market, please encompass everything. Don't just look at ES and say, oh, risk is back on, because I can tell you from a very strong footing that it's very unlikely. And my strong footing is, again, I have the regime. I look at everything, right? Those that are telling you that everything's going to be okay are looking at one thing. I am looking at everything, and I'm telling you that the odds of there being a risk-on regime are the complete opposite of the odds of there being a risk. Excuse me, the odds of there being a risk-on regime are the complete opposite than there are that we're in the risk-off regime. Now, already said at the beginning of the podcast that we are in I believe you covered it, right? 80% chance.
80%. Yep.
the 80% chance of risk off, right? So that means we have a 20% chance of risk on. So those are the odds that you're batting against right now. So I just want to make that clear that if you're calling risk on at the moment, you have 20% of the regime in your sails.
Yeah.
Could you catch it? Could the market rally, clear Momo, all the underlying components shift? Yes. Anything's possible. You have to account for all possibilities. This is the stock market, right? This is not like anywhere else where you have a certain amount of rules and those rules cannot be broken. This is not for example, this is not a game of baseball. This is the stock market. You could be playing baseball and a guy comes in with a football. Like this is the game that you're playing. This is not strictly confined to a certain set of rules because anything can happen. Knock on wood, I don't wish this on anyone, but the president could be assassinated tomorrow. Like that's not obviously something that we're putting out there, but you can have an elected official assassinated. Everything changes. The game changes. Okay, things have to be repriced real time every single day. Whenever there's a headline that comes out that which the market may have not fully priced in and it moves stronger in that direction, you see everything being repriced instantly. Otherwise, there would be extreme arbitrage opportunities that we went over this in the other podcast, which would make certain individuals excessive amounts of money, which there are those opportunities, but they are so small and so finite that you and me will not have access to those opportunities because of the market access that we have. We don't have the direct black box access. We don't have, super low latency connections where we can take advantage of certain price movements under certain releases. That's not reality. We have to play with the game that we're given, and the game that we have, the odds are the highest in winning over the medium to longer term, which is what we cover here. We don't cover intraday trading, short term. We cover, the shortest term thing that we cover are the VAMPs. Everything else is encompassing the whole regime, which lasts usually multiple months to even a quarter or two. So let's move over to ZN.
ZN.
Yeah.
So ZN still off the lows. The bond trade is not here. You're likely going to get chopped like we've been talking about. We're still in a rising rate environment, which is not a good environment to long bonds in.
Right.
So, there hasn't been much movement this past week, even with the CPI numbers coming out.
Yeah, and something to make note of. So ZN is trading at 118 right now. And if we follow the line on the trading view chart, we can go back. We are at the same price as we were in April. So this thing has gone pretty much nowhere since April. It's gone down, it's gone up, but all in all, we are still where we were 3 months ago.
Yeah.
And that's what we wanted to get at and the point that we want to make. Those that are chasing bonds, just remember the bonds buyers came in really up here in the end of February, March. This was apparently some type of trend line here. I remember there being some type of like, the 10-year can't break this trend line to the
30-year trend line, like
or something like that. Yeah,
going back like since 2000, 1990.
Yeah,
1990
or something like that. Yeah, it's like a 30-year trend line. That got eviscerated. So now rates or bonds, I should say, are chopping sideways, which we've told you was going to happen many weeks ago or many podcasts ago, where the odds of bonds actually reversing are much lower than the bonds going lower/chopping, which is why we don't have a bond position yet in our portfolio, mainly because we're still in stagflation. As you said already, when rates are rising, bonds are not favorable.
Yeah.
So let's recap what happened last week before we dive into the yield curve. So we saw headline CPI actually beat upside expectations. Okay, it came out and printed another 40-year high, and we also saw core CPI increase where estimates had it declining. So remember last week, we had the expectations of headline CPI rising and core CPI declining. Both came out beating, and headline CPI came in at new 40-year highs, above the beating that they were expected to get, meaning they came in hotter than expected. What's really interesting is we've yet to see the recent decline in commodities really impact the bottom line in inflation figures. So, as you know, crude is down, commodities, broad-based CRB index is down, but we've yet to see that effect bleed into inflation figures. So, I guess next month, let's hope and see if that has an effect. The issue with this is we also had PPI, which is the producer price index, increase this week. And expectations were looking for a decline. And what that's telling you, it's a signal that that there's a high producer level of inflation, which basically means that it's unlikely we're going to see any rapid decline in the CPI until that abates. Because remember, if producers are handling inflation or they're pricing in inflation, they're going to offset that cost to consumers. So it's usually that you have to see the inflation buck trend in PPI for it to bleed into CPI, because unless there's a huge supply of product that has already been produced and it's just sitting there, CPI, and you're going to get the oversupply where prices drop. CPI is the aftermath of PPI, because the producers have to produce a product and at a certain price. And this is pretty much oil specifically, right? So oil, you have the production costs. So if the producer takes in all these goods and services, or I should say all these products to produce the good, which is oil, and then they go and sell it, the cost of being sold is going to be reflected after the production costs instilled into it, right?
And so that's another aspect that just makes this inflation so sticky.
Right. I know, and that's what the problem is here that we're seeing with inflation numbers. It's very hard for inflation. So, this is a very good conversation. I guess we can segue into here before we go over the rest of the data points from last week. It's very easy for companies, corporations, entities, whatever you want to call them, to raise prices and match inflation. It's extremely hard for them to cut prices, because cutting prices inflation is almost like a one-way street, because when you have inflation and you have to raise the prices of goods, right? You have to raise the prices of those that are producing the goods as well, most of the time, right? So everyone's getting pay increases, prices are going up, so on and so forth. Because if prices are going up, wages need to come up as well. Otherwise, you really have what's called stagflation, right? You're not making more, but everything's getting more expensive. Growth is slowing, yet inflation is going up. So as you have these pay cuts, which we're seeing across the street, where bank employees are getting offered more and more, bonuses are going up for certain individuals. This was going right up until the last few months here. I think things are slowing down with the hiring wise. People are starting to lay more people off, but though everyone's gotten a plethora of bonuses coming up to this point, now we're into this stagflationary period where things are a little rocky. But long story short, those price increases that you're seeing on goods, groceries, all these things, and those wage increases that are going along with it, it's very hard to cut prices. It's even harder to cut wages. And
Yeah.
the only way you cut wages is by putting people off. You can't really give someone a raise, right? And then say, okay, your raise is revoked,
Yeah.
right?
So
But what you
they have to fire people and hire
right,
people at a lower rate.
that too, or they can just fire people and keep those that are on. If the economy is slowing, they don't need the workforce that you needed maybe a few. I mean, we could just look at mortgage bankers. Mortgage bankers are getting laid off left and right because they're not needed at the moment,
Yep.
right? So those, from my experience, mortgage bankers work on a commission base, but it depends on the environment. I know every bank's different. Those that are on salary, that get bonuses, that have gone up in the mortgage business, they may not be the bankers directly, they may not be the lenders, but long story short, they're going to keep their benefits most likely, while other people are being let off, and that's how they're going to reduce the overall benefits being paid. If you got 5 guys and you increase each salary by 10%, right? you can't reduce their salaries by 10%, but you can start eliminating guys, which in turn saves you the bonuses that you've given out to the other three.
And so
That's the idea.
is that something we should be looking for as
Yes.
a deflation pivot?
Yes, and that's where we're going to pivot. And that's a good pivot point into the next bullet point here is jobless claims. So let's talk about jobless claims. They came in slightly higher last week, about 9,000 over the unchanged estimate, which is not anything to chat home or run around the street talking about, but we're currently sitting at 245,000 claims. Like I said, this is not a level of distress. And with the unemployment rate at 3.6%, there's a lot of room for the Fed to continue on their path. The path that we are, that we've been very adamant about, and the path that everyone wants to think is going to be pivoted. The Fed has a lot of room higher here with rates. We're at 158 basis points. We have the terminal being priced in like early Q1 2023 at 300 and roughly 60 basis points. So there's almost another 100% of rate hikes, a little over 100% of rate hikes to go.
Mm-hmm.
100% increase, I mean. So for those that don't know, it's usually when the employment rate exceeds 5% where we begin to see a real economic stress / recession risk accelerate. And what does that mean? So right now the unemployment rate's at 3.6%. In COVID, we had it rise all the way up to 15%, pretty much. In the GFC, the Great Financial Crisis, we went up to 10%. In the dot-com bubble, we went up to about 6-ish%. Okay, in the last stagflationary period that we had, where this whole recession and the Fed chasing, employment basically whipsawed between 5 and 13%. Sorry. So we're at 3.6%. Now, the important part about this is that we are basically on the forefront of seeing certain things happen. We're seeing retail sales on a month-over-month come in printing higher last week, which is in line with expectations. So retail sales month-over-month are quote-unquote bouncing, right? On the other hand, industrial production month-over-month is coming in lower, or came in lower last week, which again was in line with expectations, expecting it to come lower. So you're seeing retail sales pick up and industrial production still sliding lower. And this is where we're going to pivot into the University of Michigan consumer confidence. So we had a preliminary reading this week, and this reading increased, coming in at 51.1, and this was higher than the unchanged expectations from the prior reading, which were 50. So what is this telling you? Well, consumer confidence, despite this, remains extremely low. We're still at the lowest level since the 1970s.
Yeah, well, that kind of makes sense. We're kind of in a
Right,
similar situation as we were back then.
right. Right. So we're still not seeing that lift. So, like I said, you're seeing this bid up in retail sales. Everyone, as I said earlier in the podcast, and this is the predicament that I was talking to you about earlier, is that the market's pricing everything in, right? But if the market was pricing everything in, consumer confidence will slowly lift, right? We're seeing this lift, but we're still extremely low. So you can't make the point that the market's priced everything in, which our point, I know this is going to sound confusing. We believe the market's priced everything in, and that's how the system picks everything up, right? The system is designed to pick off what the market's pricing in. So we see the system, that's what the market's pricing in. But what you have is an environment where people nitpick. They'll say, look, retail sales month over month bouncing. Oh, okay. Consumer confidence extremely low, but we're off the lows. We were expected to be 50. We're at 51.1 preliminary. So, oh, look, everything's going to revert. That's not how this works. Okay, we can we can grind higher slowly and still have problems. So it's very important that we pay attention to everything and not the singularities of the market, everything about the market. And regarding the University of Michigan Consumer Confidence Report, they state that the current assessments of personal finances continue to deteriorate, reaching its lowest point since 2011.
Well, you're also
So,
seeing retail credit card debt at all-time highs. I don't know if it's
right,
all-time, but it's making new highs. So you're seeing retail basically having to use debt to survive through this inflation, which is never a good
right.
sign.
That's never a good sign. Well, what ends up happening is you have real wages dropping and credit card use going up, right? That's really what you're pointing at, which is basically the wages you're earning for inflation are getting deteriorated while the expenses that you have continually go up. So, a good way to think about this now, and to put this in an understandable context, think about it like this. Imagine you go to the store and you buy, let's call it soybeans. I know this is just an example, so just bear with me. And you buy $150 worth of soybeans every month. Okay, and you make $200 a month. So you're left with $50 every month. Let's say soybeans inflate, right? And your wage stays the same, but due to inflation, that's soybeans inflating. You have declining real wage growth because your wage is no longer growing; it's actually declining with inflation. So let's say that $150 worth of soybeans goes to $250, right? But you use your credit card for this every month. Now you're forced to put the $250 on your credit card. You get paid $200, but now you have $50 sitting on your credit card. You were saving $50 earlier, but now now you're losing $50 on credit card debt.
Mm-hmm.
And
And
you're not
so,
losing it, you're charging it onto credit card debt, but you're not doing anything differently. You're not saying, "Oh, I'm gonna go out and live a baller lifestyle. I'm gonna do all this thing. I'm gonna eat at the most expensive restaurants. I'm gonna go drink the nicest alcohol. I'm gonna do everything that I want to do." You're literally doing the same thing you were before, except the wages that you're getting paid are now are essentially being eroded by inflation, and you're forced to hold debt on a credit card.
and isn't this kind of like an unsustainable path? So if
Of course.
retail is putting everything on credit cards to maintain their lifestyle, and then you get rates rising as well, so all the debt that these people have starts compounding interest on those.
Yeah.
It's not really
I
sustainable. Eventually, it's going to reach a peak where people can't keep using debt to sustain their lifestyle. So they need to either cut back on what they buy, which would cause a demand destruction, which would
right.
be deflationary, or they need to. I guess I mean, I feel like that's the that's the only option actually.
Well,
Like,
yeah, I mean,
what
like,
else would you do? You know, you just gotta
well,
start paying off the credit card, paying off your debts, and cut back on the lifestyle, which we're not seeing right now.
yeah, so that's a good point. That's really where I, I want to segue into this, and before we finish up the what happened last week, or the recap of last week. For those that don't know, JP Morgan's earnings came out this week and they were not favorable. Um we saw, I think the stock slid 20, I think the stock was down 2-3% on earnings day. Let me pull it up here. And it bounced back afterwards on Friday, but on earnings release, it fell 3.49%. Let's see, for the week, or for the year, excuse me, we're down 28.72% on JP Morgan. And the reason I bring up JP Morgan is in their earnings report, they basically added another $428 million aside for sour loans. So they are, what you said, Artie, is you think the banks don't know this, that there's a problem? They're putting money aside to account for defaults.
So they're expecting a lot of retail to default on their debts.
Well, not so much default, but their note in their earnings release was that there's a modest deterioration in the economic outlook, and they're putting money aside, which they're forced to do because they're a financial institution, right? They all have to all these institutions have to have money aside in case of credit card defaults, because it's a debt, right? And this is not to prevent any type of issue from 2080 all over again. There's a lot of regulations, which some of these existed prior, but long story short, banks are under extreme scrutiny to make sure that they are always solvent. So if they have a lot of outstanding credit card debt, they have to back it up with cash, with reserves. Now, they're putting money aside for this specific reason. There's a deterioration in the economic outlook, and they're putting money aside for potentially sour loans. What does that mean? That means that in the case that there are defaults, they have money put aside. Now, no, let me put it to you this way: no, while there is regulation, no company is just so proactive about anything, right? No one's proactively putting over $500 million for no reason.
Mm-hmm.
There's a reason. It's because the odds of default continue to rise as the odds of a recession continue to rise as well. And remember, the unemployment rate, what I was speaking to you about earlier, is at 3.6%. In average, the unemployment rate during a recession rises to above 5%. So it's very easy that the unemployment rate can double from here. And as you said earlier, with credit card debt at new highs or regime highs or multi-decade highs, multi-decade highs, and real wage sorry, I can't talk today. Real wage growth declining, that is a problem if the unemployment rate really starts to rise, because those people that are suffering now just to meet their bills, they lose their job. That's a default,
Yeah. And so
right?
that would be kind of a precursor to a deflationary regime.
Right. Exactly. And let's wrap up all of these bullet points from last week into a few sentences. And I think the way that we can summarize that for those listening is the Fed continues to hold a runway because they will push the fold until they break employment. And what does that mean? That means that the Federal Reserve has two mandates: maximum employment and price stability. Long story short, to control one, you have to break the other, right? So to control or to get price stability and control, you have to break employment. Meaning, if prices are rising excessively, right? How do you stop it? You break the economy, you break employment, right? Everyone's laid off. No one's gonna. That's extreme demand destruction. These are extremes, but this is how this works. It's like a seesaw, right? Now let's just say no one is working, or you have extremely high unemployment. How do you fix the situation? You boost prices via price stability, aka inflation,
Mm-hmm. So they have to
right?
stimulate.
Stimulate, exactly. So we are at a seesaw right now, and you can think of price stability, right? If you draw a mental seesaw in your head, and on one side you got price stability, on the other side you got maximum employment. Price stability is much higher than maximum employment right now, right? So maximum employment is way low, so price stability, aka inflation, is way up. How do you fix that? You have to push you have to break unemployment to bring down inflation. Now the Fed's going to tell you, oh, we're going to break unemployment slowly and we're going to get inflation just in line, aka soft landing. When you start breaking unemployment, it's not something that's like it's not something that just like you can chip away at. And I guess the best way to explain unemployment is similar to like a very thin glass sculpture. So not like one of those big, like a very thin blown glass sculpture where like almost if you lift it up from one side, you break it. That is unemployment. You have to lift everything up very, very carefully and still it can tip over and just break. And the way the Fed's doing this, we're talking about excessive rate hikes back to back to back. I don't think that this is going to end the way people think it's going to end, but we're going to let the deflationary regime tell that to us for us. We're not going to sit here and make doomsday predictions. Not that it's a doomsday scenario, but more of we're not going to sit here and tell you that the world is over and we're going to go into an economic crisis the worst you've ever seen. But by all this talking nonsense that you see on TV, like especially by the precious metal sellers, they love those narratives. They want you to buy gold, they want you to buy silver, they want you to the monetary system's going to shit, all this other nonsense. But a long story short, gold is down big, so that's tough for them, I
Gold
guess,
is not
right?
the play right now.
Yeah,
And we've
that's
been
tough for
saying
them.
that for like 6 months now. I don't
I
even know.
know.
It's been a long time.
I know.
We
I'm
we
kind of
tried to
tired
warn
of.
everyone.
Yeah, I know. I'm kind of tired of saying it because I've beat my chest so hard about this gold thing that now it's down and I just don't like. I don't know what to tell you.
The amount of people, gold bugs on
That
Twitter,
fought us. That
that
fought
fought
us is
us on it,
ridiculous.
and they just don't want to see it. They
Yeah,
think
like if
inflation is up, gold is what you have to buy.
Yeah, like if I'm wrong, I'm all for coming out admitting that I'm wrong. Very rarely do I um the only times that I want to admit that I'm wrong is if I forget that I'm wrong. I'm not even joking. Like if I'm wrong, I'll tell you.
Yeah.
There's no reason for me to hide if I'm wrong or not. Because it doesn't harm, it doesn't hurt or benefit anyone. If like it's indifferent to me if I know if I'm wrong or not, but I know that there's a moral code that, like, especially in the markets, that everyone wants to always tell you about how they're right. Like, that's not how this works. If I'm wrong, I will tell you I'm wrong, because there's no point in me hiding it from anyone. It's not like, oh, I can't. No one can know if I'm wrong or not because it damages my opinion. Because quite frankly, I could give a fuck about anyone's opinion. It doesn't matter to me, right?
I think it's the
So
ego. That's why people
yeah,
have
yeah,
issues admitting
yeah.
they're wrong. Like David Hunter, he's wrong. Like he's already
Yeah,
wrong. It's not like, oh, is he gonna be right? No, he's already wrong. It's done. Like what is his
yeah.
drawdown? Like
That's
20%?
tough. That's tough because it's not even he's wrong. Like he's wrong so bad that he is like wrong again for trying to tell everyone that he's right. So he's double wrong.
Yeah, but he just won't admit it.
Yeah,
But we're
because
not like that, so don't worry about
no.
that, guys. Like we
Yeah.
will admit when we're wrong. And
Yeah.
so far, things have been playing out like we've been saying.
Yeah, I mean, a good example would be gold back in the beginning of the year. Gold actually rallied. You know, we told everyone it's not a long. Um, excuse me. We told everyone that while it technically is a long in stagflation, the stagflation we're in with the way real yields are moving, it's not going to perform well. So we won't take it. But we're not afraid of missing it. That's what we told you guys. And that was at gold 1900. I think it was gold 2000 pretty much. We looked wrong,
Hmm.
but we weren't crying about it. It's no big deal. Like, we don't care if we miss it or not. This is like, you guys already know. We told you guys that we are going to miss this move, right? And sure enough, we told you the reasons why, and they're coming true today. And the same thing with commodities. We were wrong in the sense that commodities could go much higher. That's where we were wrong. And what I'll explain that to you guys right now. So back in when we had the stagflationary pivot back in the beginning of this year, the CRB index was trading at about 21. It's at 25 right now, and it went bearish trend in the last week, but it's at 25 from 20. So we're up decently, right? We peaked around 30. So there's about 10 points there. Okay, that's about 50% of gains there. We didn't catch it. Why didn't we catch it? Well, our outlook was that constantly that as commodities constantly rise, the Fed is going to be forced to move, and as we see that that's what's going on today. That's where we are at today. We personally don't want to take positions that are against the Fed. Now, was there a little runway there? Yes. What do we do instead? Well, we shorted semis, we shorted high beta. Those are paying off well regardless. But besides that, that's besides the point. We weren't long commodities. Could you have been long commodities? Yes, in stagflation. The problem is that historically the regime of stagflation is very short-lived and it burns out right into deflation. So you're left holding the bag, especially with the fighting the Fed. So this was not something that we wanted to hold. Now, a lot of people saw that and were like, "Oh, you could have held commodities." Yes, we're wrong for that. But we don't see that as a downside. We just see that as something that we don't it doesn't matter to us, because when the time comes to allocate capital, we're going to use um, calculated and concentrated leverage on the things that we want to own. So the things in between don't bother us. But yes, that's us being transparent. We did not catch the move in commodities in the back end of or in this entire or at the back end of the stagflationary regime when we saw the markets roll over.
Hmm.
Commodities last year were a different story, middle of last year, but that's a that's not, that's not what we're talking about now. No, we were not in commodities, but that's besides the point, because at the end of the day, the regime is the king. We follow the regimes because over time, that's where we win. It's not, oh, you missed this commodities move. Okay, I want you to go back to every stagflationary regime from now until 2006 and long commodities right before, for those usually lasts a month to 8 weeks, 4 to 8 weeks. Sorry.
Yeah, before switching to deflation and
Yeah.
completely crushing all commodities.
Yeah. Yeah. So that's where we stand. Did we miss it? Yes. But at the long term, over the regimes that we've registered, this is negligible. So that's where how we look at it, and I hope you guys can understand where we're coming from. It's not that we don't care about catching these moves. It's that these moves are minuscule in the grand scheme of things, especially when you're talking about leverage. A lot of people on the internet do not know how to use leverage. They use it inappropriately, inefficiently, and they're very lackluster about it. And what ends up happening is you get caught holding the bag with your pants down in a room, and you're done.
Yeah, just like that.
Okay,
Just one trade, you're
just
done.
one trade, and you're done. Um, and I think this is where we're gonna pivot into the yield curve. So you want to go over the yield curve here? You have some words about this?
Well, yeah, so the yield curve was flat for quite a while now, and I would say it's officially inverted. So you've got the 2 year higher than the 30 year. You've got the twos, fives, sevens, tens, all inverted. Actually, the tens the only one that's not inverted. The
The
tens
tens
and
tick,
20s.
the tens ticked back.
Yeah. So yeah, that's something to note, but it is still fairly flat. So bonds aren't pricing in a deep recession.
Not yet, no.
Despite of what everyone's saying the world's ending. This is going to be the worst financial crisis you've ever seen in your life. You see that all over Twitter. Bonds aren't really saying that.
Yeah, and I think that what you're getting at is the entire term structure itself, right? So we have the 3 month at 239 basis points, which the big oh, the market's going to shit is everyone likes to do the 3 month and 10 year. And we've said this for weeks, if not months now. The 3 month cannot invert fast enough. Realistically, if the Federal Reserve wasn't behind the ball, this would have been inverted already. The twos and tens are inverted for that specific reason. The twos can look out more than 3 months. It's 2 years, so
Hmm.
that this can encompass the next 2 years. This is only the next 3 months. So this encompasses the next 2 years, and this encompasses the next 10 years. Obviously, encompassing 2 years covers almost all the moves in the pricing into the excuse me, it covers all the market price moves by the Fed at the moment, right? So we're at 312 basis points. This is at 292 basis points. So this is an inversion. Now, why is the 3 month not inverted? Well, because this can only go out 3 months. There's more than 3 months left of rate hikes.
Yeah, and
And
just a
that's
quick recap on what an inverted yield curve means. If you see it inverted, that's essentially bonds saying rates are rising. So in the short term, rates are rising, and in the long term, rates are getting cut because the Fed needs to stimulate because you're in a
right.
recession.
So it's basically saying that I think in market purchasing terms, no one is buying short term debt. They're chasing long term debt.
Yeah.
They'd rather not own this because there's more upside risk here than there is here.
Hmm.
And that goes back to your point. Yes, the Fed's gonna have to act um hawkishly here. Dovishly here, where they're gonna be hawkishly here.
Yeah.
That's what's going on. But let's look at the Fed forecaster and what we're looking with rate hikes now. So we're seeing odds of pretty much 75 basis point hikes back to back here in the next two meetings. Now, this can change, but this is where we're at today.
Yeah. And that was actually priced in before the CPI numbers even came out. So maybe futures
Yes.
knew that the inflation print was going to be higher than the Fed expects.
Right, and when you say it wasn't exactly the same, right? I want to clarify that this was like 2.6 or 2.5, 2.6-ish. Now it's
Yeah.
2.94.
Yeah.
But you're generally right, yes. And this is why we look at the market. Remember, this is our mantra since day one. The market most likely knows what is going to happen. The market is almost always right. Betting against the market is the dumbest thing you could do. Like, why be the guy sitting there trying to get away counting cards when you could be the house? Like, this is like the market is the house. So just play with the market. Odds are you're going to win over time.
Yeah, exactly.
You know, This is now, instead of sitting there betting, all your money on Black 30, Black 24, or Black 32, like this is like you could sit here and be the house instead. So let's talk about this then. What's the change? What happened after CPI? This was 2.6. Now it's 2.9. What does that mean? Remember, this is the number of hikes. So this is telling you that there is a 100% chance. So the whole numbers mean 100%. So there's a 100% chance of 2 hikes. Okay? And then there's a 94.8% chance of the 3rd hike. And here it's telling you in September, there's a 100% chance of 3 hikes and 16% chance of a 4th hike. That's what this is telling you. So why do I say this? Look across the curve. The lowest point we're actually seeing the June 2023 higher than the May 2023. But these are all 39.7%, and these are all sub 50% readings of a cut. So there's not even a 50% chance of one rate cut going out to June 2023 at this moment.
And that's not a very recessionary sign either. If we
that's
were
very
headed into a recession, they would be pricing in rate cuts.
Right, because we're not you know what this is? This is not confident inflation will be resolved that quickly.
Mm-hmm.
Right, because remember, to get deflation, you need inflation you need disinflation, right? To get deflation.
Yep.
You need inflation to be dropping. So how can inflation be dropping if the Fed's not cutting? This is the one thing about the Fed. The Fed's always so quick to act with cutting, very slow to act with hiking, right? They're very, very quick to stimulate. Got to stimulate. Oh, people can't suffer. But when it's time to like suffer on the other way and hike, it's a slow, drawn out process. This is like the hawkish, the craziest thing that we've seen in a long time, the way that they were hiking rates. But this isn't. I mean, we're still at 158 basis points. Look here, the effective federal funds rate is 158 basis points. We're looking at a 354 basis point peak in February 2023, pretty much 350, 355 in February and March of 2023. Does this slide higher? As in the case where inflation is stickier? Yeah, it does. If inflation remains stickier, this will slide higher. Right now, it's telling you that this is where we're going to have to sit for a while. Even going out to June 2023, we're at 334 basis points, 335 basis points on the EFFR. Right now, it's pretty much double, double where we are today.
Is that kind of indicating a drawn out recession? Drawn out inflationary period. So
yeah, that's
kind of
what it is.
High inflation.
Yeah. Yep.
Maybe 5 to 7% inflation drawn out over the next 2 years.
Yeah, I mean, look at it this way: we're at 9.1, right? Let's see if I can pull up. Let me see if inflation chart for you guys. Okay, this is where we are. We're right here. We're 9.1. The 1980s peak was 14.8. Let's just say after the 1980s peak, or this is a little lower, the 74 peak, which peaked in September of 74. By the time it went under 5%, it took 2 years. From 1980, where we were at 14% or 15%, by the time it went under 5%, it took almost 3 years.
So yeah, it takes time.
Right. So we're here. By the time we get back under 5%, it may take a year. And that's what this is telling you. Because remember, the Fed can't just hike rates and then decide to cut them if inflation doesn't abate.
Yeah, they may not necessarily need to continue hiking, but they need to maintain a higher rate. And that's kind of what you have to do to get a soft landing. Because if they hike too much, that's when shit really hits the fan. But that's not what they're trying to do. They're trying to get a soft landing.
They're trying to get a soft landing, is true. I know what you're saying.
The way you do it, you raise interest rates to the point where it's not completely destroying inflation, but it's not letting inflation continue to get out of hand. And so it slowly pulls back and it takes time. But that's how you get a soft landing.
Until you break the unemployment rate, though.
Yeah, it's a very fragile thing.
I know. That's the problem. That's what I was telling, what I was explaining earlier about the glass sculpture. If they are going to try this soft landing, but if inflation persists and remains sticky and growth remains in the shitter, right? It's very hard for people to grow with this type of inflation. You're going to end up having layoffs, unemployment rate rising. That's when the soft landing, what appears to be a soft landing, the rug gets pulled and you go straight into the shitter. And it begin hardcore deflation. So what you're seeing here is the attempt of a soft landing. The problem is to get this soft landing, you really need growth. So think of it like this. Think of this as the soft landing. Let's go to our regime tab. So we're here. We are here, and this is what is in front of us. Think of the soft landing as we're here and we start declining. We get to this brink where we start shifting into deflation, right? Where both growth and inflation are falling. But we see growth start to accelerate. And we get expansion.
Yeah. That would be best case scenario.
That is your soft landing. That is your soft landing. The Federal Reserve can hold rates up to where they are right now long enough for growth to pick up, start coming back, and basically they can put a peak in inflation while or they basically can revert inflation. They can keep inflation going up, and you would get you'd actually go past expansion, go right into inflation, right? Because CPI and growth would both be rising at that point. But you would need to get a topping action in inflation. You need to slow inflation enough to pick up growth. It's a very complicated process. You need to slow inflation enough where growth can spark up and get off the ground, and then they can both rise together. The problem is we're at a level of inflation where growth realistically can never catch up to such a read. Growth can never exceed a 10% inflation rate.
Yeah.
There's no amount of growth that you can have that can outpace that type of inflation. That's why the Fed's targets are always like 2, 4, whatever. I think it's 2%. They moved up to 2.5% or something like that. That was their target rate, because at 2%, remember, the Federal Reserve's mandates are maximum employment and price stability. And in their minds, maximum employment and price stability are around that, occur around that neutral rate, right? Which now they're saying is like I forget. I think one of the Fed officials came out and said it this week. Let's see what they said. Let's see. Okay, so Harker came out and said that the neutral rate should be above 3% by the end of the year.
So what does that mean?
Remember, the neutral rate is the rate where monetary policy is neither expansionary nor contractionary. It's neutral. So what I'm saying is that's the target rate where basically employment is sustained. 3%. It was 2% for a very long time. But it's not something that the neutral rate is kind of fairy dust, right? There's nothing on paper. There's no definitive indicator that defines the neutral rate. The neutral rate is basically what the Fed thinks will do the best for employment and price stability.
Mm-hmm.
So it's I'm sorry to say this, it's kind of bullshit.
Yeah, it's just kind of a guess.
And the problem with the neutral rate is the Fed can never maintain the neutral rate. A good example of this would be, let's see. So here, the Federal Reserve was hiking basically to get to their 2% target, and they were cutting and cutting and cutting. Right? And let's go back in time. Their 2% neutral rate it's always going up, above, and below. You're never holding it. For 10 years, we were basically under the neutral rate. We got to the neutral rate for 6 months. We were around there. And then we haven't been at their quote unquote 2% neutral rate since 2019 and between 2018 and 2019. But prior to that, it was all the way back in 2009.
Yeah, they just can't maintain it.
They can't. It's a whole lot of horseshit. They tell you this stuff because They have to have targets. This is the thing about Wall Street, right? Banks need to have my price targets, need to have my expectations, my upside and downside targets, my levels. Like this is all some bullshit. Okay, like if you really had price, if you really knew the neutral rate and it was mathematically explainable and it made sense, we would be there. We would try and stay around there at all times. But the reason is, it's not real. The economy moves in waves like this. Neutral rate. The neutral rate is forever changing.
Yeah,
You
it
can't have one neutral.
depends on
Yeah,
the climate of the economy.
yeah. And they're gonna say that it's. Don't get me wrong. They do change it, right? They come out all the time saying, oh, it's 2, 2.5, 3. They always, for the years that I followed the Fed, they've always adjusted it. But it's not. It's a bunch of bullshit because you're never actually there. They spend more time talking about where neutral rate is than actually talking about being a neutral rate.
Yeah,
So like it doesn't matter. It's a
it's
very
fugazi.
deal. Yeah, it's Fugazi target, whatever. But let's segue from this into liquidity. Excuse me. So we basically are seeing the dollar skyrocket, and you're getting everyone saying, "Oh, the peak in the dollar soon." I know this. I know what everyone's thinking. Dollar's gonna peak. Or now you're getting people on the internet saying, "Oh, the dollar's not real. Merely a reflection of two bad currencies, being the yen and the euro." The
Hmm.
dollar is very much real. Okay,
Yeah,
there's no
it's the most
discount.
real thing out there.
Yeah, there's no discounting that the dollar is not real. Why is the dollar going up like this? Well, I'll give you 3 bullet points: the euro, the yen, and liquidity. Okay. If you take a look at our screen right here, we have a few things. We have in blue the dollar index, in orange the ANFCI, which we have a whole video on this, and we'll make some more in the future explaining exactly what this is. But for those that don't want to go back and recap, we'll make this simple. It is the um, adjusted national financial conditions index. What is that saying? It's by the Federal Reserve Bank of Chicago, and it's a financial conditions index that's adjusted for growth and inflation. Anything above zero, we're at 16 basis points. So anything above zero is considered above average tightness in the market, or above average stress. Anything under zero is considered less than average, or more than average weakness, right? Or more than average easing. Okay, so above is tightening, below is easing. We crossed this helm in May. We were riding up all year. This is something that we said was going to go positive, and now we're decently into positive territory. We're well under COVID highs, but this was a different event. Remember, we had a massive amounts of tightening. The whole economy shut down. Of course, this is going to be parabolic. Don't compare this to COVID. Just know that we are above average tightening, right? And the dollar index in turn will most of the time follows ANFCI, because as liquidity worsens, access to capital becomes more constrained, right? So as liquidity goes down in the market, or things become more stressful, people stack cash, they spend less, they hoard dollars for safety. The access to capital, aka dollars, becomes constrained, so the value of the dollar goes up. Okay, that's one reason.
Yeah, it becomes
Now,
deflationary.
deflationary, right? But we're yet to breach that point in the regime where we move to deflation. We're in stagflation, which in reality the dollar's best regime is deflation, but the way it's performing right now is more of a liquidity problem than a deflationary problem. In turn, it's still printing deflationary symbols within the United States dollar currency, right? But the reasons are not because of a deflationary regime. The reasons are because liquidity is so poor
Hmm.
and continuing to deteriorate globally, not just within the United States. So, for those that don't know, high interest rates, right? As you push interest rates higher, it pushes the rates across all products higher, right? And it basically entices demand for fixed income products where you have to lock money up. So as interest rates go up, the supply of dollars go down, because you're locking up these dollars in in vehicles if it's, let's just say the treasury, right? Now,
You're locking up money in interest paying assets.
right. Now, just because the treasury has infinite access to liquidity. So don't take it as if you're buying treasuries, right? Oh, that liquidity is still there. It's used by the treasury for something else. Yes and no, because those dollars become less and less accessible to the average person. So here's a good example. Euro's going to shit. I mean, we've made a couple of videos and we've gone into depth about how that's going to shit, right? That's a same thing with the yen. Can they be saved? Yeah, I mean, of course, anything can happen, but the leaders of these banks are not, of these central banks are not.
They don't want to
They're
save
not.
it.
I don't. It doesn't seem like they do. I mean, like the euro area, the ECB just came out and said that they have a new tool of like unlimited bond buying. Like, what the fuck is that about?
That's Japan 2.0.
Yeah, that's what I'm saying. So like, if they're doing that, like, it's just a curse. Really, like, easy stimulus is a curse. Once you're cursed with excessive stimulus, and the United States is not exempt from this, right? We have it too. Once you give easy stimulus, like the Federal Reserve printed trillions of dollars in the last couple of years for what? To save everyone from a hard time. Like that's really what happened. And it's a curse in that sense because once you do it once, whenever you do it once, it's expected from you every single time. If you don't think the market goes to shit and we get a bad deflation regime and the Fed is not going to cut all these interest rates back like nothing, don't you realize that again we're going to run down a path down the road where they overstimulate, we're going to have more inflation again down the road? That's how this works. You overstimulate, you have to over tight. It's just a back and forth, and eventually something breaks. Look at Japan. They just said, "Fuck easing, fuck tightening. We're gonna forever ease." Sorry.
Mm-hmm.
So what ends up happening is you have people that lose faith in the currency. Like those people that work in Japan, God bless their souls, because they're just eating inflation out the ass.
Yeah, there's no reason to be holding that currency.
Yeah, literally. Okay, there's not defaults. There's credit swaps that that are used to hedge out inflationary risk in their treasuries, because their treasuries literally. You want to talk about real yields? The real yields across the curve, like the United States has one of the best real yields out there out of the Japan, the ECB and between the Fed, ECB, and BOJ, the real yields in America right now are the best, but they're still not great.
Well, so is that another aspect that's driving up the dollar as well?
Yeah, that's another thing. So demand for treasuries or inflation protection, right? Foreign, like the inflation protection. So this is an interesting topic, because if you have euros and you want to get access to United States bonds, right? You have to convert your euros to US dollars to buy the treasury denominated debt. So there's dollar demand to buy the bonds, right? But now you're holding dollars, okay? So you're no longer holding euros, so you're pretty much exempt from euro inflation at this point, right? And because as the euro inflates, the dollar only gets stronger. So the bonds themselves appreciate without interest payments because they're US dollars,
Mm-hmm.
right? So now your only concern is the inflation within the United States, because obviously the US dollar is a superior currency in this at this point in time. And for whoever says Bitcoin, God bless your soul. So the dollar is superior to the fact that you are converting your deteriorating currency into something that's appreciating. So you already get your your alpha is being generated just by doing that. Then you're holding bonds and collecting a yield on top of that.
Yeah,
If you're buying bonds within the euro, like, so for example, now let's say it like this: a United States individual or an American citizen that wants to buy euro bonds, it's got a problem in that sense, right? because he has to convert his US dollars to euros. So he's taking an L there because the euro is going to continue to depreciate. And he then has to go and buy the bonds, which the real yields are not competitive.
Yeah,
So he's
so
stuck.
the best
So
place to
now,
put your money is US bonds.
at the moment,
Yeah.
right? But the problem is you're still not seeing them bounce. You're still not. Well, I mean, you are slowly, but like you're still not seeing them turn around. And I think that's because we have yet to see the financial systems really say this is it.
Yeah, it's not fully apparent yet. And
Right.
you need to have deflation.
That's
Deflation
my
needs
point.
to
Yep.
happen.
Yeah. And when the entire globe sees U.S. bonds start rising, that's when the chase comes. Right.
And so
Hear me out.
where do
Here,
we see
here.
US dollars going in the short
I
term?
I think they'll continue to go higher. But hear me out on this. Right. Let's just say you have the euro. Okay. And the dollar's going to continue to go up. Right. But bonds start catching a bid. Remember, if you buy a bond at a 3% yield and the market yield goes down to 1%, your bond's appreciated in value without any interest payments, right? So hear this. You're a euro, you have euros, you start seeing the bid in bonds. What reason do you have not to convert to US dollars? The dollar's appreciating. You're getting a potentially a positive real yield depending on what maturity you're buying, right? And the duration and whatnot. And you're getting bond appreciation. You are banging all angles. Like there's literally no reason why you shouldn't be buying them,
Mm-hmm.
right? And that's really where we stand today.
Yeah.
When does that event happen? Because it's very likely that event does happen, and that's what's going to create the next bull run in bonds. You're going to have global liquidity coming there because it's the one of the only, in the times of tightening, I would only dare you see Jay Powell get up on the stand and say we need to do stimulus right now. Just imagine what would happen. We need to stimulate. And this goes back. The reason the ECB needs to stimulate, long story short, is the situation that they're in. We went over this last week. You can't tighten two economies at one time. You have Germany, you have Greece. Greece is partying, Germany's engineering. You can't tighten both of them the same way. You'll blow Greece up. So what is the ECB doing? Oh, well, it's real simple. They're tightening proportionally. They're helping certain areas while tightening other. They're trying to mastermind the whole thing. It's not going to work like that. It's just not. They're buying Italy. I think it was Italy and Spain. They're buying their bonds, or is it just Italy off the top of my head? I don't remember, but they're buying a region's bonds to basically prevent their credit spreads from widening. So they're trying to nitpick and prevent explosions in certain areas. This is not going to work. This is fairy tale.
Yeah.
But
And
let's talk about volatility before we get off this topic.
yeah.
As you can see here with liquidity, right? The ANFCI is the brown or orange, depending on your screen, line, and the green line is VIX. As you can see, when liquidity worsens, or AKA when liquidity tightens, right? That's worsening, and loosening is easing. So as liquidity tightens, you end up with higher VIX. Why is that? Well, simply put, the less liquid things are, the faster and harder they move. And unfortunately, it's usually to the downside. So as liquidity deteriorates, VIX likes to rip. Over time, this is something that we like. The megaphone moves in VIX happen when liquidity when liquidity tightens. Excuse me. These megaphone moves, as you can see here, liquidity is loosening. Right, excess liquidity everywhere. VIX is rather shallow. It's only until we see these explosive moves or I should say, liquidity deteriorate that we start to see expanded VIX movements. Look where we are today. It's obviously VIX has been rather wide here, but this move is very bad sign for VIX.
it's kind of something that can happen at any moment, essentially.
Right. Now, look, last time we were here, we saw this the ANFCI tick all the way up to negative 23. VIX was pretty much chopping anywhere from 11 to 22. This is almost this is 36 basis points higher, basically. So we are almost double, and VIX is at 24. Not good. Not good. That means that this has no. Everyone is basically saying, "Oh, VIX is breaking down the turn in equities," right? I've seen, and I should say everyone, but I've seen some people say that. Okay, the VIX is at 24. It can easily go to 45. With liquidity going on the path that it's on, VIX can be 45. So pay attention to liquidity, to the dollar, to VIX. Until you see the system pick up a risk-on regime, your sales are being filled with risk off. Until you see risk on take over, the odds of risk off are very relevant. It is not something to be ignored. It's not to say, "Oh, I'm going to buy equities here for the breakdown in VIX." Like, this is counter regime things that people like to do. Not that it's usually because they don't know the regime. They're like, "Oh, VIX breaking down with long equities." Yeah, all it takes is 2 days and VIX to be at 35. I've seen that happen many times where people are like, "Oh, I'm buying," market edges up higher, and then 2 days later, VIX at 35, market's printing new lows, and they're like, "Oh my god, I gotta cut this," and I have to tell them, I'm like, "Yeah, you are stepping in front of an oncoming train, which is risk off. Wait for the train to pass and grab on and follow it and risk on, then to stand in front of it and try and hold it back. Go with the tides, put the winds in your sails, whatever analogy you want to put. Always go with the flow. Don't sit here and fight the trends, because that's not going to do anything for you. It's not going to help you. It's going to create a lot of stress. It's going to create a lot of despair when you realize that you're just not getting ahead. And that's what we intend to do here. We intend to show you guys the way we do things. Again, we're not financial advisors. We can't tell you what to do, but we can tell you what we do, and how we manage our money, our assets, and how we get ahead over the longer term, excuse me. But I think that's where we can leave it off today. If you guys have any questions, feel free to message us in our Discord. The link to join our Discord can be found at www.market-radar.com. Our Twitter handle is @themarketradar. You can find us there too. If you have any questions, leave us comments here on Twitter, in our Discord. We'll be happy to get back to them as soon as we can. Thank you so much for listening, and we'll see you next week.